Hello, I'm Brent Wilsey, and with me is Chase Wilsey. We're from Wilsey Asset Management. And today we're going to talk about value versus growth. Now, this has been talked about on Barron's, talked about on CNBC. A lot of people might say, well, what is value? What is growth? I thought it was just stock market. I thought it was just investing. Well, no, there's things to it. So what do we mean by value and growth? What value is, it means you pay less for the book value, the earnings, the cash flow. You're trying to get value for paying for something. With growth, what growth is you don't care what you're paying for something. You're just trying to buy growth companies. There is something called GARP, which is growth at reasonable prices, but still growth is not. Over the last, 100 years, 60% of the time, value has outperformed growth.
Yeah, I mean, just kind of looking at it simply, I'll call it, I think value is a common sense approach to investing, and growth can be very crazy. So that's kind of the way we look at it, and it's very hard for me to value growth. Can't really value it, but
you can't, and they really don't.
And for us, it's just really hard to stick to discipline, and that's one thing we always talk about is when it comes to investing, you have to stick to your disciplines. I don't think there's much discipline when it comes to growth investing, so I think that's why a lot of times investors struggle when it comes to growth.
And there's been the Nifty 50, the tech boom and bust. Over and over again, we've learned that growth can really hurt you on the downside. I love this saying, well, I'll get out before that happens. No one really does, but they think they will. So value actually has underperformed the last 9 years compared to growth. So people saying, value doesn't work and so forth. They don't look at history. And actually right now the spread is the highest between growth and value companies. It's been since 1980. So what's going to happen? It could keep going higher, but as it goes higher and higher, that fall down is going to be much, much deeper.
Yeah, and a lot of this can be attributed to those FANG stocks, Facebook, Amazon, Netflix, and Google, which were up so much last year. And, two sectors that are really kind of good values right now are both the financial industry and auto industry. A lot of financial companies right now are trading at a discount in their price to tangible book value, which is always good to see. And then the auto companies, Ford and GM, are trading at PEs, price to earning ratios of 6 and 7. So you're getting a great value in terms of earnings for those autos and price to tangible book value for those financial companies.
It's kind of like you want to buy it on sale or be the first guy to get the first cell phone, the first whatever it may be. You're going to pay the high price for it. So I like buying stuff on sale.
Yeah.
So let's talk about the automotive fatalities. 38,300 died from car crashes.
Yeah, it was actually up 8% over last year. And this is the first time this has happened in many, many years that we've actually seen an increase in these fatalities. And the reason we've been seeing less and less is because the auto industry, the cars are getting safer and safer. But this was not a good year in terms of car crash fatalities, unfortunately.
Well, we can blame this on the better economy and low gas prices, because if you're paying less for driving your car, you're going to be in your car more, driving more miles. So that's why fatalities are up. It's what's actually going on.
Yeah, and Buffett actually kind of came out and spoke about this because he does own Geico, the car insurance company, and he said he blames distracted driving. What he means by this is people texting while driving, on social media while they're driving, Snapchat, always taking pictures of themselves, and it's getting a lot more dangerous for people when they're driving and not paying attention to the road.
Yep. And so actually what's happening is that this is going to affect insurance companies. How's it going to affect them? Because now you're going to have more claims going up. You're going to cost more for the insurance companies, so it's going to their earnings are going to go down. But what's going to happen is as their earnings go down, they're going to raise their premiums, and then that will bring their profits back. So it might be a good time to look at some insurance companies because they could be, I think they might be stale for a while, I'll put it that way.
Yeah.
So, and some pay some good dividends as well. I was at a charity event over the weekend, and I was asked about, what do you think about alcohol companies and these companies? So I said, well, we are kind of looking at Brown-Forman Corporation, and the chart on this, which we're not chart readers, but wow, look how great this looks.
Looks great.
It looks great. But again, what is the price you're paying for it now? That's what I look at now. Current price around $98 a share. The 52-week low, $87 a share. The high, $111 is where we stand.
Yeah, and one thing we took a look at here is the price to tangible book value is 82.42. The industry average here was about 20. So you're paying 4 times the amount for the tangible book value of the company. Not a great value in terms of the price to tangible book value here.
And let me show you a little trick on debt. We show long-term debt 87, total debt 123. What this tells you as an investor, that about a third of their debt is short-term, and as rates go up, they may have to refinance at a higher amount. So these are one of those little tricks we look at and why we do well better than the average investor because we'll look at these things where they got a lot of short-term debt, which could cost them more money.
Yeah, well, I mean, what are they going to have to do when that debt comes due? They're going to have to refinance it. Do they have the cash to pay it off? So just a lot of things to look at here. And also looking at 2017 earnings per share, they're estimated to make $3.60. This gives them a forward PE of 27. Again, that 40-year average for the forward PE is 16.5. So it's not looking like a great value investment here.
Yeah, going back to the beginning, it's a growth stock, and again, you overpay for something, sooner or later, it's going to come down. So be very careful. We do not like the company, got some great properties and assets and so forth, but too expensive based on the earnings. So maybe you think about investing, you're thinking, gosh, it's pretty hard, I don't understand all this stuff. Well, that's what we're here for. We dig deep into all this stuff. Like I talked about the debt and the short-term debt, long-term debt. We look at all this stuff every day. We do it 50, 60 hours a week to make our portfolio grow. That's what we're here for. If you want a free consultation, talk more about it, give us a call, 858-546-4306, or go to our website, smartinvesting2000.com.
And be sure to go to the website now so you can sign up for our upcoming workshops happening this Saturday, March 19th, from 10 a.m. to 12 p.m. And we'll be hosting it at National University in Rancho Bernardo. At the workshop, we'll be analyzing locally based Qualcomm. We'll be reviewing stock fundamental analysis and why it's successful. We'll be showing you when to buy and sell a stock, and very big here, going over the 5 common mistakes the average investor makes.
Hope to see you there.